Hey, happy June investors. I got a nice YieldMax, YMAX update for you guys. So I made a video about YMAX when they first came out, gave my opinions about it. Now, I wanted to give an update on this particular ETF just because I've been getting so many requests to do an update on YMAX. This is the YieldMax Universe Fund of Options Income ETFs. This fund is a fund of funds, meaning that it will primarily invest its assets into certain YieldMax ETFs. So it's going to be buying all 21 of the YieldMax ETFs, and then every month they're just going to keep reallocating and rebalancing so that exposure to each of these ETFs is about the same. So since there's about 21 ETFs out there, each fund is going to get roughly 5% exposure. So this is actually one of the few, if maybe the only, YieldMax product out there that actually operates like a real ETF. YMAX does. See, the other ones, they're all just synthetically owning one position, and since it's being synthetically done, they're not actually owning the underlying equity. Long story short, this is basically a way to get exposure to the different YieldMax ETFs out there without putting all your eggs into one basket, and hopefully get those juicy dividends. Now, YieldMax, they've been around for about 4 months. They came out in January of 2024. And what's amazing is this ETF has now paid out 4 different distributions, and they've actually gotten higher and higher. So it started off at 53 cents, then 57 cents, then 63 cents, and their latest distribution was 73 cents. So those are some super juicy dividends that they have paid out so far since their inception. I love to see that it's increased every single month. And unlike a couple of funds that are in YieldMax, the NAV has actually not eroded. This has been a big problem with some of their products in the past, but this ETF is right about even from when it started. It really has not moved at all. Now, if we compare this to the S&P 500 and we just reinvest the dividends, bro, that actually shows us that the total return of YMAX has actually been outpacing the S&P 500, which is absolutely incredible. So YMAX has returned close to 14%. Again, this is with the dividends reinvested, and that's slightly higher than the S&P 500's 12%. That is a very impressive streak. Again, super small sample size, right? This is only 4 or 5 months. We really have to see how YMAX performs in different market conditions and over long periods of time before we can really judge this ETF. But so far, it's off to a very hot start. Also, seeing the NAV be intact, that actually means the fund is making money and investors have been rewarded. I've been seeing some very questionable videos being put out recently that NAV erosion is a myth or that NAV is not important. I've put out several videos on why this is a myth and why that's extremely dangerous thinking. If you see the NAV going down, that usually means the fund is either not making enough money or they're paying out way too much in distributions, and that is definitely not sustainable. That's just basic common sense, guys. Also, just one other thing to keep in mind is that the S&P 500 or the stock market has done very well in 2024 so far. So that's really going to favor income ETFs like this, so it's really no surprise that the fund has done this well. YMAX will do solid in bull markets, but the bear market, that's where I think the true test is going to come in. It's going to cap some of those returns if the stock does very well, but remember, we're getting exposure to all the downside risk. But anyway, let's go over some of these YieldMax funds. So there's lots of great companies in here, right? We got the Teslas, we got the Apples, the Nvidias, which just crushed another earnings report. We have the Amazons, AMZY, making a lot of homeowners nervous these days. We got companies like Facebook or Meta, Google, Coinbase. And again, you'll kind of notice a common trend with these companies is that they tend to have higher betas, meaning they are more volatile than the overall stock market. There's a reason YieldMax does this is because then they're able to harvest that juicy premium, which pays out those big dividends. Now, one particular fund I want to take a closer look at is the JP Morgan Chase one, JPMO. So we can see here that their distribution rate is close to 25%, which is absolutely incredible. JP Morgan Chase, the stock, gives a 2.3% yield. So I totally understand people wanting that 15 to 25% yield with JPMO every single year. But one thing I don't understand, and I've yet to see anybody counter this argument, I don't understand this over the long run is why would anybody own one of these YieldMax funds if the underlying equity does better over the long run? For example, since JPMO has been out since September of 2023, it has returned a 16.6% return, which is an absolutely fantastic return. But if we had just bought JP Morgan Chase shares over the same time span, that return would have been 41.2%, meaning JP Morgan Chase shareholders who just held on to the regular stock would have had double the return of JPMO. Now, I understand, guys, dividends are great, but they are not free money. Just selling off a portion of the big gains associated with JP Morgan Chase stock would have been much more efficient, probably much more tax efficient. I really don't get this allure from younger investors who are just buying a bunch of these funds expecting to retire by December for cash flow. I can maybe see the case where those who already have plenty of money, they're maybe close to retirement or in retirement, I can maybe see a reason why they might like these funds because they don't necessarily need to grow their wealth. They're just looking for a steady stream of cash flow. And these income ETFs, they can be a lucrative investment. This is the problem when so many people skip the investing basics in hopes of getting rich by December. They're missing out on all the fundamentals of investing. Now, by making some of these mistakes, they're going to be missing out on so much money. And over the long run, this is going to become so inefficient. At the end of the day, you need to do what works best for you. Random people on the internet do not care about you, and they don't care what you do. Can YMAX be a tool used to build wealth? Yes, absolutely. There are scenarios where it can be profitable. Do I personally think in the long run that this is the most efficient way to make money? Absolutely not. Now, we have a Seeking Alpha article about YMAX, that it's a new sleep well at night or a swan for income investors. Now, I think that's a very generous title for a fund that's only been out for 4 months, but it gives a lot of pros about this ETF. I'll just kind of go through it in case anybody wants to stop and read it, just as I am a partner of Seeking Alpha. So it's a ETF that offers a yield of over 40% so far, right? And it's also, guys, remember, dividend yields, they're not guaranteed. Dividends are not guaranteed. So just because a fund has been doing well and paying out dividends, that doesn't necessarily mean that next June they're going to be paying out dividends. And income ETFs like this, the dividend is always going to be variable. It's never going to be exactly the same. Like we were talking about earlier, guys, this fund is going to equally weight all these different YieldMax products in here. So you're getting exposure to all these different products, all these different investing strategies. That's why I personally think owning YieldMax or YMAX is much better than owning any of these individual ETFs. We just saw that companies like Salesforce, this is as blue chip as it gets. This is a Dow 30 stock, and they dropped 20% after an earnings call. Guys, this is billions of dollars that were lost in a matter of minutes. So I get so many hysterical comments that I always have to chuckle at, where they're like, you know what, I'm gonna sell the stock before it goes down, or I can predict black swans, I can time the market, stuff like that. Guys, nobody can time the market. Tough times do happen and recessions do happen. Black swan events like this happen where the stock just shoots down. Again, with a lot of these covered call ETFs, you're getting exposure to all the downside risk, but only some of the upside. So if Salesforce then goes back up or shoots back up, we're going to be capped at some of those gains. And that leads back to what I mentioned at the start of the video, NAV erosion. And that's going to cause those dividends to go down. This doesn't mean I'm a hater. I'm just stating the facts. But I know a lot of people don't want to hear that. They just want to have these imaginary fairy tales where, you can retire off a $100,000 portfolio and get $70,000 and get $10,000 in cash flow, or they've unlocked some sort of secret that the rest of Wall Street has no idea about. Guys, make sure you're making smart decisions. I definitely don't want to see anybody losing money out. So make sure you've joined the Discord in the link below. We have an entire forum forum in there of people who want to see you succeed. We even have a section in there called Investing Sins, where we go over some very common investing mistakes that people make. I want to thank all my Patreons for the continued support. Make sure you leave a like or a dislike if you didn't like the video. Leave a comment if you disagree. I'd love to hear what your position on YMAX or any of these other income ETFs are. And hey, maybe I might learn something from you, so let me know in the comments if you think there's something I'm just not getting. And I will catch you on the next one.